Today we're going to start off with a slightly different approach. So if you're not familiar with what we're looking at here, or what it has to do with cryptocurrencies, then you're in the right place. Buy and hold is widely considered to be the holy grail of investment strategies, especially when it comes to stocks. However, it's kind of crossed over to cryptocurrencies now for many of the same reasons that it is considered so good with stocks. The efficient market hypothesis, transaction cost, tax differences, as well as the emotions associated with trading versus just holding. However, in this video, I want to go against the grain a little bit here and talk about why I don't think that it's the best strategy for cryptocurrencies, despite the fact that I employ it with my stock market portfolio. But before we get into that, I want to start off with talking about why it's considered so strong of a strategy when it comes to stocks. Because that's really where this is all originating. That's where everybody is thinking about the buy and hold strategy. That's where the common knowledge of it comes from. And that's where all of these thoughts about timing the market and every other argument you can think of with buy and hold really originates. In fact, one of the biggest proponents for buy and hold is Warren Buffett. And many of you are familiar with him, even if you don't come from finance, right? So Standard & Poor's releases this report biannually, or every 6 months, where they compare their indices against active management. Now, we're going to use these indices as a proxy for buy and hold, and we're going to use these active managers as a proxy for the trading strategy. Now, for those of you from traditional finance, you know that that's not necessarily true. Some indices have very high asset turnover, and some active managers have low asset turnover. However, in general here, when we look at active managed funds, they're going to have triple or more the asset turnover than a passively managed index. So I hope you can forgive the little semantics here. It is important in the field of finance, but in terms of looking at it from a broader point of view, I hope you can look past it. Okay, and for those of you who have no idea what I'm talking about, don't worry about it. So they released this scorecard here that you can see that the way it's set up here, you're looking at the percentage of actively managed funds that have underperformed the relevant benchmark in each category. So for example here, this is large cap equity. So this fund is going to invest in companies that are worth $10 billion or more in market cap. And of course, the relevant index is going to be the S&P 500, right? In general here, that's going to be the concept. And it goes on and so forth, so that it's an apples to apples comparison here. And you don't make any mistakes by comparing large companies like Johnson & Johnson that have no chance of ever growing as fast as a small biotech, right? That's the concept behind this. Now you can see here across the board that the majority of active managers underperform the relevant index. So in other words, trading underperforms buy and hold strategies by quite a bit. And what's funny about this is that the longer the time horizon, the more likely that buy and hold or passive investing is going to outperform active investing. And there has been a ton, I mean an absolute ton of research that goes into supporting this. Very basic fact, right? And what they also found here is that, for example, let's say we look at large cap growth here. You can see that only 38% over the course of 1 year underperformed the relevant index, right? But when we go into 3 years and 5 years, you see those numbers go all the way up to 75% underperforming. What's interesting about this is that they also release another scorecard where they basically look at the top funds, right? These are the top quartile, right? These are the best top 25% funds by return in September 2014. And as we carry forward throughout the years, what they find is that you see a significant drop off in the number of funds that stay in the top quartile, right? In other words, of the 631 funds that are in the top quartile in September 2014, only 21% of those remain in September 2015, and only 3% of those remain by the time we get to 2016. What this means is that basically active managers that outperform are generally just lucky, which is a very sad fact for many of us that are in that business, right? I don't want to get too far into this because I know many of you are interested in cryptocurrencies and not equities, but I want to point this out. This is a main reason why buy and hold is considered a superior strategy, because you can see that across the board here, active managers generally are going to underperform the relevant index, which simply buys and holds, right? Whereas many of these active managers actually trade, okay? Now, the other reason that buy and hold works so well with stocks in particular is because of the fact that they are cash producing assets. What we are looking at here is the last filed annual report for Google. And what you can see here is that in 2012, they made $10.6 billion. But if we go to 2016, you can see that that has nearly doubled to $19.5 billion, right? Now, this is an extreme case of growth, but what I want to point out about this is that if we think about where Google's going to be in 2037, just think about that for a second. Can you fathom how much money they're going to make by 2037? As they realize the present value of those cash flows, the company's going to become worth more and more in general, right? In general. There's going to be situations, of course, where all of a sudden the business model gets invalidated and perhaps the company goes down in value. But overall, if we think about it in the long term, it is almost a guarantee that Google will be worth a lot more 20 years from now than it is worth today, right? In fact, there's a study that shows, and I did this myself, believe it or not. I went back to the 1960s, okay? There's been other research that's gone way further back than that, but I went back to the 1960s, and what I found is that if you look at the S&P 500 returns over any 15 to 30 year period, there is no period in which you will actually lose money. If you bought at a peak and sold at a valley 15 years later, you still would make money in almost every single scenario. Okay, there actually was not a single 15-year period, as far as I recall, going back to 1960 that would have lost money, and certainly not over any 20-year period. So what's important to realize about this is that there is tons and tons of research that's gone into buy and hold, and plus it just makes sense with equities because they're cash producing assets. Let's move on to the portion of the video that you're all likely going to be the most interested in, which is the discussion of cryptocurrencies and the buy and hold strategy. First of all, because they are not cash producing assets, we're less certain moving 15, 20, even 30 years into the future that they're going to be worth more then than what they're worth today. The future value of a cryptocurrency is entirely based off of the utility worth of the network, as well as the future expectations of growth in that network. And I don't know if I'm going to pronounce his name right, but if you read the works of Chris Berninsky, he goes into crypto asset valuations. I would really encourage you to read his work on Medium. It's very interesting. He tries to basically take some of the more traditional models that we have from finance and the valuation of equities and other commodities, for example, other asset classes. He tries to apply them to cryptocurrencies, and it's very interesting. I would encourage you all to read it. What's important is that it's very heavily based off of adoption, and we don't know which cryptocurrencies from this list are going to be around 20 to 30 years from now, right? In fact, if we just look at a snapshot of this list just 2 years ago, 2.5 years ago, you can see that the distribution of this list, the ordering of this list is significantly different, right? Some cryptocurrencies are not even in the top 100 anymore. So what I want to emphasize about this is that while there will be winners and losers, there isn't enough data moving backwards for us to really know for sure what's going to happen moving forward. We don't even have 10 years of data with cryptocurrencies, right? So the first reason is because they're not cash producing assets and it's completely determined based off of adoption, there's a little bit more risk associated with buy and holding. But that's not my number one reason. The number one reason why I think the buy and hold strategy may not be the best for cryptocurrencies is because I think it's a less efficient market. And that, in my opinion, is illustrated greatly through the volatility that we've seen in the last 2 months alone. But really, this has been true throughout the entire history of Bitcoin, right? I mean, you can see just how much it moves up and down and how insane some of these candle wicks can be, right? So what I want to emphasize about all of this is that because Bitcoin is so volatile as a result of the demographics of the people investing in cryptocurrencies right now, it's easier to time the market, and I think the efficient market hypothesis is a lot less true. In addition to that, the trading costs associated with Bitcoin are much lower than they are in the traditional markets, right? So when we think about commission fees, it's completely free on GDAX, right? Your limit orders are completely free on GDAX, and a number of other exchanges, I think they're free as well, or you pay a very small commission, right? Like Bittrex is very small when you compare it to traditional exchanges for stocks. So your transaction fees are smaller. Okay, you still pay higher taxes for short-term capital gains, but in general here, what I want to emphasize about all of this is that when we talk about cryptocurrencies, the buy and hold strategy, I know that it's common perception among the community. I get it, and it works for the majority of people, and I would say it's been the right strategy over the last couple of years, but I tend to think it's going to be something that works well until it doesn't. And if you're going to employ it, I would do it with Bitcoin, and I would encourage you to stay away from the other major cryptocurrencies. I know this was a fairly controversial video. I would love to hear your discussion about it. I know that there's a lot of talk about this on all the different forums as well as on some of my videos, so I thought I would bring it up because I think it's a hot topic. I hope you all can be open-minded to the idea that maybe buy and hold isn't the best strategy, but I'm also open-minded to the idea that it might be, right? Because obviously cryptocurrencies are the future in my opinion, so maybe I'm being too conservative with that. But for now, I will continue to trade around market events. Perhaps it's a mistake, perhaps it's not. Let me know in the comments. And as usual, I will catch you in the next video.